Our roadmap begins with the markets trying to hold their ground after one of the worst days for equities, as we said, in 8 weeks.
Dell's profit falls 72% as the company looks further out to that potential future under private ownership.
And described as an unusually stylish geek, Yahoo CEO Marissa Mayer is in vogue, literally. We'll show you the magazine in just a moment. But first up, more signs of waiting for prompter here, seemingly weak economy. Housing starts up from June, but below consensus. Mike Santoli, how much damage done yesterday with Dow below 50-day moving average, the stocks, financials, the transports, all the same?
They had acted, the market had acted kind of ragged for a couple of weeks, and then yesterday, I think a lot of things from two different sides hit it, right? To me, it's not just the fear of the Fed taper. It's the fear of the Fed taper at the same time. Everything else doesn't look unequivocally great, such as the consumer when you had the bad retail earnings. I also find it's interesting how the market doesn't like when labor market data is better than other economic data because they feel like the Fed's fixating on that. And we had all these years when the labor market lagged GDP and everything else. So to me, it's more the market continuing to come to terms with the idea that it's no longer a heads I win, tails you lose market.
Yeah. Right. So what actually happens when we get the taper? I do wonder. I mean, it's almost the fall. Is our stocks going to actually react negatively yet again? Is the bond market going to actually reverse itself and do something unexpected?
Yeah, that's the question. So where's the 10-year yield at the time when we actually get the confirmation that it's here? And is that a short-term time? In other words, does the bond market kind of build it in already? And who knows?
Dan Greenhouse over at BTIG points out, we've been through this before, right? There was a June period where we bottomed out. Since that time, the 10-year is actually about 25 basis points higher, but the S&P is about 6% higher.
Yeah.
So can that argument continue where people, whether they realize it or not, are in an environment where higher rates can coincide, albeit with the normal adjustment turbulence, he says?
Yeah, that's what I think has to happen, right? So the stock market kind of makes its peace with why the yield is going higher, and it can happen in a very violent way, too. I mean, I think that the other thing that we don't know exactly is you're seeing that people not liking when the yen rallies. And so you have all these kind of correlation trades that seem to be on out there that are related to, developed market yields staying very suppressed, and that's no longer the case.
I mean, to be fair, this is August, of course, and these are extraordinarily low volume days. We've seen the prevalence of ETFs and the like have a real impact, of course, right where we are. But also, to be fair, it's not been a great earnings season. I mean, this week, Walmart, Macy's, we're starting to be concerned a bit about the consumer, although they're doing very well when it comes to actually housing. Not bad on housing.
Right, although Nordstrom today echoing what Kohl said earlier in the week.
But car sales, but there does seem to be a divergence in terms of what consumers are willing to spend their money on at this point.
And with a backdrop of 3% nominal GDP growth. I mean, we have to keep in mind the pie's just not getting that much bigger, just in terms of total output and spending.
Although J.P. Morgan, Tom Lee's been bullish all year long. Apparently their slide deck today talks about Europe coming out of recession, right? I mean, global GDP rebounding a bit. The PE multiple expanding. Earnings per share for the S&P. Some of their figures are a little bit startling, but we can talk more about that later. But that is the bull argument. Continues to be the bull argument.
The bull argument is that you keep kind of, finding something else that kicks in just when one thing has been expended. Yeah.
Here to give us his economic outlook, S&P's chief global economist Paul Sheard joins us this morning at Post 9. Paul, it's good to have you.
Hi, Kyle.
How do you reconcile, for instance, what the ISMs are saying versus what the regionals have been saying, ISM versus industrial production? Are we in an environment where GDP will look better in the second half?
Well, we think so. We think the economy is poised to shift up a notch. But I think the market's looking at the Fed and all the discussion about tapering. And I think people are moving towards a call of September on that. That doesn't look likely to us. I think we've got a Fed here that really wants to underwrite this recovery. And if you look at the recent GDP numbers, for example, the 3 quarters since the Fed launched into so-called QE3, it's been running about an average of 1%. Now, that's set to come up. But I think the Fed's going to want to see a run of stronger data. And it's got inflation on its side here because there's no real threat from inflation at the moment before it starts to really taper off quantitative easing.
So would that mean in October? In December? Do you think it happens before Bernanke leaves?
I think probably. We're calling for December at the moment. But again, I think the thing to understand here is we're all getting wound up about tapering. It is really just the beginning of a slowdown in the incremental quantitative easing that the Fed is applying. So it's not monetary tightening, but it's starting to sort of ease off on the accelerator a little bit. but it's all results dependent. The Fed wants to see a strong recovery, and I don't think it's going to make any big mistakes here in terms of tightening too soon.
But isn't that actually the reason I think the market gets anxious? Because they worry that the Fed is intent on beginning tapering sooner than later, even when it doesn't have that economic motivation to do so.
Well, I think that's misreading the Fed, actually, Mike. They're not really intent. And, the Fed's not going to come into an FOMC meeting and suddenly blindside the markets and do some tapering.
Yeah.
So I think the June statement from Chairman Bernanke was really all about just starting to communicate a little bit more in a more granular fashion to the markets about their thinking, because let's face it, that element of forward guidance around the asset purchases was very, very vague relative to the forward guidance that the Fed gave around the interest rate, federal funds rate. So I think they're trying to just give a little bit more transparency, clarity. They'll discuss it in September, but that's a big difference between actually making the decision.
When you look at the 10-year now, and you look at what Starts did today, and making up for last month, which was pretty not good, are rates having an effect on the housing market or not?
Well, I mean, they do have an effect, I think, and of course monetary policy has an effect on those rates. And, there's a bit of a conundrum here for the Fed as well, because the Fed tries to use the yield curve and long-term interest rates to give stimulus to the economy to get that recovery. But of course, if it gets the recovery, long rates are going to go up and the yield curve's going to steepen. So there's always a kind of balancing act here. And if the markets get ahead of themselves, the Fed will start to rein them in.
Do you think we hit 3 anytime soon?
Well, I'm not really a bond strategist. I'll leave that to people who are a little bit more qualified to make that call.
Before we let you go, tell me what you think the health of the consumer is. I mean, we see certain things, auto sales, for example, very strong, but we've gotten some reports this week from major retailers that indicate not so great.
Yeah, I think the consumer is, in good shape, in better shape. There's a healing process going on here. I mean, we're coming up to the 5th anniversary of the great financial crisis. And, economists, Dave, will tell you typically it takes about 10 years to work your way out of these major financial crises. So, consumer demand still being subdued at this point, is not something to be too surprised about. But it is healing, it's getting stronger, and that's really the basis for the sustainable recovery.
All right, Paul, thanks for coming in.
Great,
Happy
thank
Friday.
you.
Paul Sheard.
Well, Dell has reported a 72% drop in second quarter profits amid falling PC sales. The company's ongoing buyout battle, of course, will continue today, in fact, in court in Delaware, but looks very likely to happen. Results for the period still did manage to beat Wall Street estimates. You can take a look at what the numbers were, of course. But Dell is running at about a $2.4 billion operating income number for the year. That is if you actually take the first half and just assume that you're going to do roughly the same numbers in the second half. Doesn't mean you're going to at all. And, of course, continues to fight on the low end of the PC market with the likes of Lenovo, pressuring margins. Of course, one of the key reasons why Michael Dell and Silver Lake have said this company needs to be a private company for us to actually do what needs to be done in order to retool it for the new age, so to speak. We'll see. It does look highly likely, as I said. Of course, it's been nice to have a week or so off of not talking about Dell after talking about it every day for what seemed like months. But we are going to see some court action today in Delaware. Vice Chancellor Strine is going to be weighing in on Carl Icahn and his contention that, hey, you should not be holding the meeting, that is the annual meeting, so far after you hold the vote. They should be concurrent, that being the vote on this deal. September 12th, I believe, if memory serves, is when
it is the 12th.
You'll have that have the vote on this deal. But again, it's $13.88. You'll also get the 8-cent dividend, and the voting standard has changed. Everybody knows that. The real question is, what's the business going to look like for them, private or public, given the incredible loss that they've seen in both market share and profitability?
I mean, to me, that whole line that you always hear about how, if you go private, you can operate outside the glare of Wall Street. That's code for you can shrink a business that needs to be shrunk. And, you really can't be a public company and not at least pretend you have a growth story. So maybe they can kind of right-size this thing around whatever is working within the franchise. I don't really know.
Or is this quarter, is the story cutting prices to steal share? Is that one reason Cisco had sort of the tone they had earlier in the week as they put pricing pressures on servers, on PCs, things that aren't selling well, but they need to move?
And then you had the opposite, reaction to the numbers, which said, well, does Dell even have any motivation to put up a good quarter? Or not? I mean, I don't even know how the game theory works there.
And of course, Icahn and Southeastern will tell you, well, they're simply just making it look as bad as they possibly can. For their part, I think Dell management says we want to maintain these customer relationships, whatever it takes, and we're not going to be beaten on price at this point because we need to move everybody up the value chain, but we want to continue to have those relationships in place and not lose them. We'll see. They're still not going to close this thing until October, I think, because there's still got to get Chinese antitrust.
Right?
And so we still are going to have a couple of months to talk about Dell and look at the business before it does highly likely become a private company, unless we get a very unexpected ruling today in Delaware.
Well, we thought the last 13Q was going to be the last.
Yes.
And it turns out it wasn't.
No,
so
it was not.
We'll see. Meantime, Marissa Mayer is going Vogue, literally. The CEO of Yahoo profiled in the September edition of Vogue magazine, including, of course, a photo spread. Not only is she described in the article as the CEO of the moment, but also as an unusually stylish geek. In the article, she also hints at her vision of the future. Quote, email, maps, weather, news, stock quotes, share photos, group communication, sports scores, games. You're listening to what people do on their mobile phones, and it sounds like a list of what Yahoo does. By the way, the actual book itself, you could work out to this magazine. It is that heavy. I don't know how many ad pages it is, but it's very thick, and there's the spread toward the back. I think it's a 3,000-word profile, if I'm not mistaken. It's a hefty look at a. Some say, is this the new standard for PR among the modern CEO?
You know, I cannot speak to my company's, PR strategy, but honestly, I actually think that most of the attention is incoming. I don't think it's necessarily a thrust out there. People are interested in somebody, her age, going from Google and taking over, this company that really had been kind of set aside for a while.
Yeah. I don't begrudge somebody in their mid-30s enjoying the spotlight. Of course, she's been working very hard, but you do have to watch carefully, make sure the PR thing doesn't get too out of hand. Kind of like when hedge fund managers start buying sports teams.
Exactly.
You just want to keep an eye on those things. Probably
or piano companies?
Does that qualify? I'm not quite sure what that was about, but Paulson will tell you, hey, the economics will justify it. They'll make money on that, on the Steinway purchase. But the turnaround is still going on. It's not as though it's done. And I know I don't want to put you in a tough position as somebody who works
I don't think
for the
anybody
company.
would pretend it.
Yeah.
Interesting, though. I mean, and people, when she came in, people thought of her as a product person, not necessarily the showman that she's actually turned out to be. Some of that offsetting, some of that geek quality that she came into the job
For sure.
with. But interesting piece and worth reading.